about organization, its strategies, its management practices, and indeed how well it is managed. Shri Keki Mistry is a chartered accountant from the Institute of Chartered Accountants of India and a certified public accountant from the Michigan Institute, USA. And he, as I said, brings with him over 3 decades of varied experience in the banking and financial sector. He joined HDFC in 1981 and he was initially having several responsibilities with the HDFC and been on the board as executive director since 1993. And he has of course held several other positions as time has gone by. Besides being on the board of HDFC group of companies, including HDFC Bank, Mr. Mistry is also on the board of Great Shift India Limited, Grigor Investments, Mauritius, India Value Fund Advisors Private Limited, Infrastructure Leasing Financial Services Limited, NextGen Publishing Limited, Sun Pharmaceutical Industries Limited, Shrinuj and Company Limited, the Great Eastern Shipping Company Limited, Torrent Power Limited, and the Bombay Stock Exchange. He is also the non-executive chairman of Crew Finance Limited, a subsidiary of HDFC Limited. Some of Mr. Mistry's recent recognitions include being awarded the CFO India Hall of Fame by the CFO India magazine in 2012, being honored with the CA Business Achiever of the Year award in the financial sector by the Institute of Chartered Accountants of India in 2011, declared as the best CFO in the financial services category by the ICAI for 2008, CNBC TV 18's award for the best performing CFO in the financial services sector for 2 consecutive years, selection as the best investor relations officer in the corporate governance board by Asia Money in 2008. I'm sure there are many more that we are not aware of, but this is a small part of what we could cull from the public domain. It's indeed an extremely great honor for me to welcome you on behalf of all of us to this university, and we look forward to your words of wisdom today. Thank you very much.
Well, thank you very much for those kind words. The topic I'll be speaking on today is importance of housing in the economy and lessons from the global financial crisis. Chairman of the Board of Management of the Ahmedabad University, Shri Praful Hanubai, Dean of Amrut Mody School of Management, Professor Bhavish Patel, members of the Board of Governors and Board of Management, faculty members, students, and distinguished guests. It's a great pleasure to be here today at your prestigious institute. Having completed only 3 years, the Ahmedabad University is already on its way to becoming a leading institution in the country, as it is ably supported by high quality and reputed faculty. As students of the Amrut Mody School of Management, I'm sure you are proud to belong to this college and appreciate the strong grounding that the college is imbibing in you. It is encouraging to know that the management school is continuously striving to maintain a high quality in its educational curriculum. Whenever I talk to young people, I always tell them how lucky they are to be in India at this point of time. You belong to the world's largest democracy. Half of our country's 1.2 billion people are under the age of 25 years, implying a huge and promising workforce. India will move from being the 9th largest economy to become the 5th largest economy in the next 7 years by 2020. Just look at the leap that is happening in India. It took us in India 60 years after independence to become a $1 trillion economy in 2007. We are now set to become a $2 trillion economy by 2013, which is just in the next in a year or so, and a $4 trillion economy by 2020. I believe the current decade will be a period of both great opportunity and challenge for India. Yes, the Indian economy has slowed down, but so has the rest of the world, including all the emerging markets and the BRIC countries. For instance, in Brazil, GDP growth is projected to go down from 2.7% in 2011 to 1.5% in 2012. In Russia from 4.3% to 3.7%. And China's growth too is expected to come up its high of over 9.2% to come down to around 7.8%. As far as developed countries are concerned, the US is just about beginning to recover, while the Eurozone has slipped back into recession. Although the journey has become bumpier, I do believe that India's long-term growth story is still very, very intact. One must remember that India is a consumption and a domestic-driven economy, and more importantly, people of this country are consuming all of what is being produced, and on top of it are demanding more products and more services. As most of you would know, until 3 months ago, the India story was being written off at a remarkable pace, and analysts were saying that India would be amongst the first of the BRIC countries to fall off the cliff. To add to the views, rating agencies were threatening to downgrade India to junk status, and obituaries on the Indian economy became cover-page stories in the media. Positively, the tide turned in India's favor, and in September 2012, the Indian government announced a slew of measures which significantly changed the sentiments within the country and also the image of India outside the country. Opening up of FDI in various sectors, including multi-brand retail, aviation, broadcasting, power exchanges, then divestment in 4 public sector undertakings, and a whole slew of other measures which were announced in a matter of 2 or 3 weeks thereafter. With these announcements, the sentiment suddenly changed. These announcements were heralded as India's new wave of big bang reforms. The media was abuzz with the feeling that these were bold measures and that the animal spirit had come alive. The excitement was understandable. After months of logjam on various policy issues, it was encouraging to see the government getting into action. It was definitely a good start, as there was growing recognition that the Indian economy needs many more measures and reforms. There has to be a continuous process for the momentum to sustain. We must not forget the huge potential India has to offer. If nurtured properly, the rewards will bring an exponential growth. I wish to emphasize the enormous future prospects of India. India's greatest advantage is that its growth drivers are self-sustaining owing to favorable demographics, a growing middle class, entrepreneurial spirit, strong consumption, and a very high savings rate. Further, unlike other commodity-driven BRIC countries such as Brazil and Russia, the Indian economy is not a one-trick pony and has a diversified market. A McKinsey report estimates that in several product and market categories, such as mobile handsets for example, India could account for more than 20% of the global revenue growth in the next decade. Let's now move to the main topic which we are here to talk about, which is housing. If one looks at the global dynamics today, housing is the one reason why developed countries have slumped, while ironically, housing is also the reason why developing countries are growing at a rapid pace. Either way, housing always remains at the core of any economy. In India, it is estimated that for every rupee invested in the housing and real estate sector, 78 paisa is added to the GDP. The housing sector in India is the second largest employment generator and ranks fourth in terms of the multiplier effect it has on the economy. The housing and real estate sector has significant backward and forward linkages with nearly 300 industries, which not only contribute to capital formation and generation of employment and income opportunities, but also catalyze and stimulate economic growth. If one looks at the growth of housing finance in India over the last 20 years and compares it with India's economic rise, the success of both can be attributed to the structural changes that are taking place in India. For instance, India has favorable demographics, with 60% of its population being below the age of 30 years. India's middle class is estimated to rise rapidly from 250 million individuals currently to nearly 800 million by 2030. A young population, growing nuclear families, and increasing job opportunities has transformed the attitude of the current generation. Younger people want to buy their own home, and unlike the previous generation, they are not as debt averse as they were. Over the last 10 years, mortgages have grown from 1.5% of banks' advances to as much as 10% of banks' advances currently. A Boston consulting group IBA report estimates that outstanding mortgages will increase 8-fold from a level of from the current level to something like 40 trillion by the time we get to 2020. Given the importance of housing in the economy, it is imperative to understand the root causes of the subprime crisis that originated in the US, created ripples in Europe, and later escalated into a major financial crisis, and also to understand why India is so different and why we believe such a crisis will not happen in this country. If you were to go back to look at the origins of the subprime crisis, the most important aspect of the events leading up to the 2008-2009 global financial crisis was that most financial experts, CEOs and regulators had all thought that they had more or less figured out how markets functioned. During the pre-crisis period, the Western financial world was in what can best be described as a state of systemic arrogance, a belief that the fundamental rules of economics and finance no longer applied. When the crisis happened, the blame game began, and all the preconceived theories and assumptions crashed like a deck of cards. In fact, the global financial crisis created a perfect storm of contributing factors, all of which have come together to create the most serious and sustained attack on the global financial system since the Great Depression in the 1930s. As a noted management expert said, the world has not just turned upside down, it is turning in every inch, whichever way we look at it, at an accelerating pace. Almost every expert has missed the big picture. Almost no one has put all the pieces together. What we know is that the financial crisis was caused by an unhealthy cocktail of greed, poor decisions, and very bad lending practices. A majority of us did not see the crisis coming because for 4 years, up to the summer of 2007, the global economy was booming. Global growth rose at an average rate of 5% a year, its highest sustained growth since the early 1960s, while inflation remained generally subdued. Many analysts were convinced that the global economy was entering a new phase, which was immune to the ups and downs of business cycles. Some economists termed this new phase as the Great Moderation. During this phase, a dramatic shift took place in the financial sector of many economies. We started to witness the advent of innovative financial instruments. There were many people who believed that financial liberalization and the innovation of sophisticated financial instruments would make the banking business more productive by enabling lenders to expand the volume of their operations and simultaneously conserve capital. As a result, in the US, this period was an era of innovation in the home loan sector. Interest rates at that time were extremely low, and that too for a very long period of time, and this encouraged Americans to take on greater leverage by going in for mortgages and home equity loans. It was not so much loans taken for buying properties, it was loans being taken against properties for the purposes of consumption. In the enthusiasm to go after the huge and previously relatively untapped subprime market or borrowers with a low credit rating, lenders introduced newer and riskier products such as interest-only loans, piggyback loans, and adjustable rate negative amortization loans. Banks sought higher yields without an adequate appreciation of the risks that were involved and the risks that they were taking in getting into that business. For example, in an adjustable rate interest-only loan, the borrower qualified for a loan only on the basis of the initial teaser rate. Very little attention was paid to the fact that interest rates could go up during the tenure of the loan, thus endangering the borrower's ability to service the interest in future. The loan appraisal process was aggressive, and in many cases there was no down payment sought from borrowers. In several cases, the borrower's income documentation was either not provided or if provided was not checked. In an interest-only loan, the borrower makes no regular principal payment. Under a negative amortization loan, the borrower pays less than the full interest due from him, with the shortfall being added to the outstanding loan. In other words, the loan amount keeps increasing with the passage of time rather than reducing, as would happen in a amortizing loan.